Welcome to My Talk, the podcast series brought to you by ISS Market Intelligence. Thank you for tuning in. The focus of our discussions on My Talk is the global retail financial services marketplace, and it's many and different verticals, be it asset management, banking, wealth management, life insurance, fintech, and so on. For more than 3 decades, we at ISS Market Intelligence and our predecessor companies have been passionate students of the business. And beyond reporting on industry headlines, what we really hope to achieve with this podcast is really to dig a bit deeper into the background and the kind of the entrails of the various topics. And to do so, we create monthly episodes, sometimes more than once a month. And so if you do enjoy this episode, please subscribe to My Talk on your platform of choice for podcasting. My name is Goshka Folda. I'm the global head of research at ISS Market Intelligence. And this year has been a bit of a whirlwind tour of the globe for us at My Talk. We have already touched down on 3 continents in previous episodes, but today I am so delighted that we're going to add one more continent to our count for this year, which is Australia. And Australia is a small but a big country in the Southwest Pacific that I think in many ways punches way above its weight in terms of global politics, in the world investment, asset management markets, in retirement policy. We have all probably heard about the famous superannuation retirement scheme in Australia, and also importantly, for those of us who are fans of music, in Eurovision. I'll let my guests tell you a little bit more about that because this is really truly that's perhaps a podcast that should be dedicated just to Eurovision presence, and Alex can tell us all about that. But it is also a market, and I have been observing Australia for a better part actually of almost a decade. And it is a market that's changing and fragmenting fast. There's some consolidation. There is some a kind of disruption that's going on. And in many ways, I think it's almost like an experiment that we from outside can watch and understand the impact of various disruption elements. Many of you might recall several years ago the somewhat famous future of financial advice or FOFA initiatives in Australia, and we've written about that in our publications, and this was really in tandem with a lot of regulatory change around the world on financial advice giving. So today, I thought it would make sense to bring an expert and dedicate this episode to looking down under to see what's going on and why. And I think in many ways, some of the developments that we're going to talk about today will maybe be portents of ideas that might arrive here in North America or in EMEA and Asian markets. So to help us to discuss this topic, I have invited Alex Dunnin, who is the research director from an ISS company, Australia, part of ISS Market Intelligence family, Rainmaker Information. Alex is Rainmaker's lead researcher, writer, journalist, and opinion maker. And I would say his opinion making capabilities extend far beyond Rainmaker. I think he's got a very, very big reach in Australia. He's also a former school teacher and a volunteer wildlife fighter in his local brigade just near Australia's capital, Canberra. And he, very importantly, is a big Eurovision fan and an India file. Alex, welcome to the show.
Thank you, Goshka, and hello, listeners, wherever you are around the world. Thank you for having me.
Thank you, Alex. Before we land on the topic of Eurovision, well, we maybe do that last, but why do you think global asset managers, wealth managers, retirement funds should care about what's going on in Australia?
That's a really simple, great, and very shrewd question. We say Australia, well, one, we play way above our weight. One of the really interesting things about, I think, Australian celebs, business leaders, politicians, when they travel the world, I'm always amazed that they get an audience with anybody. And then when you start to think about what we do, you can kind of see why. Um, let's have a look at Australia compared to the US. If Australia was the state of the US, and let's leave aside the politics where you could argue we kind of are, but if we were a state of the US, we'd be as big as Florida. So I'm going to flick the question back to you. I'm going to say, if you're in the States, would you not open an office in Florida? Nonetheless, Florida is a big economy. And if you think Florida is big enough to attract your attention as a wealth manager, then Australia is right there as well. So, of course, you should be in Florida, and of course, you should be in Australia. The question is how, but you should be here. Another comparison that I think might get the thought juices going is, let's have a look at Australia compared to Europe. Now, Europe's grand GDP is about $27 trillion, US dollars, of course. Uh, in Australia, we say if you're a wealth manager around the world and you think you should be doing business in Europe, if you think you should be doing business in the States, then you should be doing business in Australia, because we would be equivalent to a number 4 or number 5 market in those jurisdictions. The question, though, is how do you do business in Australia? And that's a much tougher question, as it is in any local market. But one thing that's really powerful about the Australian story is that a fairly significant chunk of our funds under management is contestable. We would argue that if you were trying to do business in Europe, sure, there are big markets in Germany and France, but are they actually contestable and open to competition from overseas-based fund managers? And that's actually a much more complex question. Now, not every dollar in Australia's 3 trillion Australian dollar marketplace is up for grabs, but a significant proportion of that is, say 40, 50%, depending how you analyse it. Do you have the same ratios in those other markets? We would argue perhaps not. Another way to look at Australia is, sure, we're a country of about 25 million people. Our population ranks as number 55 on the planet, but by GDP, we're ranked about 12. By pension fund, size of our pension fund, funds under management, we're number 5. Another ratio that I think is good to catch some attention is, yeah, sure, our stock markets are 2% of global stock markets, but our pension fund market is about 4% of the global pension fund market. So across all of these metrics, Australia is a much larger player than it should be. We think that's by our good management, but in reality, it's probably by a lot of good historical luck. But nonetheless, the scoreboard is the scoreboard. So Australia is a really solid economic player. We contribute around the world. And like I'm saying, you should be doing business here. And if you don't do business here, your competitors will be. And as a good Australian, we like to work with smart people. And if you're running a smart company, I'd love to talk to you. I don't want to talk to other people.
That's really well put, and I think that somehow the distance very often kind of masks the opportunity, which is quite profound, as you pointed out, and it's kind of interesting the various stats that you have brought to bear. And of course, I think one key word that you use is that this is a market that's actually contestable. So there is not kind of a lockdown that we've seen in terms of, even public sector pension plans in some other markets where really kind of retail asset management or wealth management is struggling just because there's just a kind of the public sector really commands all the attention. So moving to the institutional investors in Australia, can you tell us a little bit more about who they are and what kind of assets do they like, and what kind of assets do they like to buy?
Oh, well, talking about who are the big investment managers down here, one thing that's also nice to know, it's a pretty powerful fun fact that we like to share with global stakeholders who are casing the joint down here, trying to figure out what their play should be, or even long-established players. But that is the opportunity for our global friends. We are a very open architecture market. And what I'm saying by that is we estimate at Rainmaker that about 45% of the funds under management in the market here is run through overseas owned institutions. Now, I think there's probably no better indicator of our openness and our willingness to participate in the globally than that. And I would probably challenge many other countries, are they as open? Now, being open doesn't make it better, doesn't make it worse, but it's a statement of our willingness to engage.
Mhm.
Now, also reinforcing that is Australians, what we've been doing, and by Australians I mean institutional investors, of course, largely through our pension funds. We're very globally focused. Again, because Australia, by world standards, is a very small market, and we want to participate. Great example: you want to get involved with the tech sector, you go to the States or you go nowhere. So we're very exposed to that. But in terms of where we like to invest, about 50% of our pension fund investments, and I'm going to focus on pension funds a lot for this storytelling because it's a really big part of Australia's wealth sector. And that's been by design. And when government policy several decades set up our retirement system, which we in Australia call superannuation, it's really become the anchor point and enable the country to effectively rebuild and re-engineer its financial system. So about half that money in that sector is invested in equities, about 50-50 of that between local equities and international equities, but the international equity share is growing. About 30% is in bonds and cash. It's actually, that segment is also globalizing very rapidly. We have 15% in what we might call alternatives, which I know that word can have different definitions around the planet, but by that we mean infrastructure, private equity, hedge funds, those kinds of vehicles. About 5%, well, a little bit more, but in big round numbers, about 5% of the market is in property. So Australian pension funds, on that point, it's worth noting, as a species, are quite comfortable with unlisted assets. I know there's a lot of talk around the investment world, particularly in North America, about when are people going to start returning to the office, how that is impacting property valuations, those kinds of things. I can tell you it's a really live debate down under, but I'm just saying the pension funds are pretty comfortable working with that segment because superannuation, retirement, is a long-term investment. And so the real story is we like equities, we like alternatives, and we have a really big appetite for investing globally. Therefore, it's probably no surprise that I've said to you who are our largest fund managers operating in Australia right now. We have State Street, Macquarie Asset Management, a homegrown brand, BlackRock, you've probably heard of BlackRock, another one, IFM Investors, that's a local brand. Then we have AMP, Vanguard, Challenger, QI, another brand, QIC, Pinnacle, and First Sentier. So if you start looking at our major 10, about a third of them are overseas brands, and many of the leading brands are index specialists. That tells you a bit of a hint about what might be going on. But we're just very open to the big institutions. The big institutions around the planet are big down under, and that's driven because we're interested in global assets. So it's really a global assets and alternative story down under.
Yeah, that's really a fantastic lineup. And just to underscore just how global, many of those asset management stories are really truly global. You were just talking about the valuation of some real estate holdings by big pension plans. Of course, that's also a very, very big topic in Canada. There was just huge coverage on that. I'll share some stories about that with you. But clearly, asset management is a big business. It's a global business, and I think that the openness of the Australian market is, I think, of particular allure to a lot of, or should be of allure to a lot of providers. So maybe now a really difficult question is, how do you think what would be the best way for global fund managers? And again, you've listed some that have already done incredibly well in Australia. How should global asset managers go about connecting with the Australian market? Short of course, coming to Rainmaker and getting you guys to do some intros.
There's about 1,000 fund managers working with the boards in Australia. Many of those are from overseas, as we're saying, but also the big local ones too. Everyone is struggling for their edge. And so you therefore need to engage with the market. You need to understand its local mechanics. So if we're looking at the Australian market, we'll say, look, about 2/3 of the money that is invested comes from Australia's pension funds. So therefore about a third doesn't. So I'm telling you circles around there, but it's also sometimes good just to come back to basics all the time. Superannuation is, however, retirement is the main driver. And when we start looking at the superannuation market, you need to understand its dynamics. We break it up into about three tribes. You have what we call the not-for-profit segment, which you might call the equivalent of, in Australia, a really big chunk of our pension fund market, really big investors now, are what we call industry funds. It's a pension funds that's been set up with an industry, with partner unions and employer associations to really serve the retirement saving needs of people in a particular industry. It could be the hospitality industry, it could be the office workers industry, it could be the construction industry, it could be the healthcare industry, it could be the education industry. So in Australia, superannuation policy has really been developed in partnership with our labour movement. So we have different kinds of politics in Australia. We also have retail funds, of course. I'll double back to the not-for-profit sector. It includes public sector funds, corporate funds run by listed companies and so on. So we bundle those. The reason we call them not-for-profit is they are run by trustees, by the fund themselves, representing members, and they're not run on a commercial basis. Then another major sector is the retail sector, which is very traditional, includes commercially orientated wealth management groups in the business of making money through those programs. They tend to run big retail platforms. They could be former insurers, they could be bank affiliated with financial advisor groups, and so on. And then we have what we do call the small self-managed sector, which are effectively small private personal funds run by it might be a family couple, 2, 3 or 4 people who they may be in business together, they may be an extended family, whatever. But our retirement system, every fund is run by a trustee board, but all these trustee boards, their job is to be fiduciaries and provide overall guidance of their funds. They may not be investment specialists, however, and so they will use, like many institutions around the world, the services of professional asset consultants or investment consultants, depending how you refer to them. And those investment consultants will give them advice on how to choose investment managers. Now, when we start thinking about, well, how does that work? Well, most superannuation funds in Australia, institutional ones, I mean, so now we're talking about the not-for-profit funds, the big industry funds, as I was saying, the big public sector funds and the big retail funds, they will appoint on average 40 to 50 fund management mandates. So when these funds started several decades ago, they might have just had one fund manager running their entire program. Then they started saying, let's have a specialist just doing Australian equities, another specialist doing bonds, another specialist doing property. And then as time has gone on, as they've become more sophisticated, they've said, no, hang on, let's have several fund managers running our equity program. Some are doing value, some are doing growth, some are doing overseas shares, some are doing value stocks, growth stocks, all those kinds of things. So we're using a lot of fund managers. We're getting the advice through consultants. So therefore, if you want to reach some of these pension funds and raise money, you've got to start working with the gatekeepers, being the asset consultants, and they tend to work with the not-for-profit side of the market. If you want to reach retail funds, well, then you tend to work with the traditional research groups. In Australia, one of the major ones is, we have Lonsec, Zenith, Morningstar, etc. So their brand, at least Morningstar brand, of course, is one we're familiar with globally. So in lots of ways, it's a traditional structure. But around the world, all fund managers have somehow got to get their head above the parapet. So they've got to somehow demonstrate that what they're doing is interesting. And as we know in funds management, it is one of those industries where the scoreboard doesn't lie. It is a numbers game. And so you've got to be constantly trying to demonstrate the value you add. And around the world, the industry, I think, can really struggle with that. Hence, we have the growth of indexing. And in Australia, we would estimate that in some asset classes, indexing can be, say, when we last looked at this about a year ago, can be 25, 30% of that market, particularly in equities. And if you start looking at some of our larger international equity managers in Australia, a lot of those mandates are indexed orientated, and a lot of our top performing funds do use an index strategy, and hence the growth of ETFs and all those kinds of things. So really it's about understanding the mechanical structure of the marketplace, understanding who the gateways are, trying to talk to those institutional influencers, by and large being asset consultants, but also what we're finding is some of the larger funds, and this is no surprise at all, they increasingly do self-investment. And that was a trend started in the States, 15, 20 years ago. And we all know those famous brands that were doing that. And so some of these larger pension funds have now figured out, well, hang on, do we really need to have an investment manager sitting around running a bond portfolio when a lot of those bonds are going to be just held for next 5, 10, 15 years? Do we really need to have a fund manager running a cash portfolio? And depending how active the strategy is, how it's traded, those kinds of things, some of those trustee boards have said, no, I think we could do some of this ourselves. And as we know, when funds start to invest their own money, it fundamentally changes their governance. But also when funds start to invest their own money, they're effectively outsourcing, or they're insourcing, their investment operation that was previously outsourced. They've got to start thinking about how that works. And it might be that they start insourcing their own investment advice, or at the very least, they'll appoint their own investment teams who are just as big and tough and mean and smart and creative as the formerly just purely external advisors. In other words, they want someone on their side of the table. They want people to really challenge each other and also have the intellectual fortitude to, if a fund manager comes up and says, I think we should be investing this way, or my consultant says, I think we should be tilting our strategy that way, they want to have people on their side of the table who can take on those ideas, perhaps embrace them. But also what we've tended to find, and I wouldn't be surprised if this is what happens elsewhere, asset consultants can be a little bit conservative from time to time. And so when pension funds want to start getting into alternatives, and as I've been trying to say, Australian investors are quite comfortable about alternatives for a significant minority of their fund, they found that a lot of the asset consultants, they just weren't ready. And so the funds had to do their own research. We've had funds tell us they've had to actually sit down with their asset consultants and basically walk through why they wanted infrastructure portfolios. They've even had to sit down and walk through why they want to rebuild their bond portfolios. So they're much more independently minded, but that is part of the freshness of the thinking here, which is why we think that the Australian pension fund market is innovative. It's very returns driven. One thing we do find quite intriguing is when we look at pension fund markets in other countries, you don't have the same obsession with performance that we do down here. So superannuation returns from even, the big industry public sector funds, they are almost front page news quite regularly. And, we're part of the problem here because we survey them, we talk about the returns all the time, but the media love those stories. Superannuation is part of almost the national lexicon. It's every election in Australia now, superannuation policy is front and centre. And in fact, when governments have tried to change superannuation policy, governments have either not been able to win an election or they've almost lost elections over it. So it's really something that's part of the national, the rhetoric on almost a daily basis, which is probably quite different to other countries. But if you want to do business with Australia, understand the mechanics, understand the distribution structures, understand the tribes, understand the gateways, understand that depending on which part of the market you want to reach, you might need to work with traditional managed fund research brands that you're probably familiar with them globally. But if you want to reach some of the larger not-for-profit pension funds, well, then you need to work with their specialist consultants. And those consultants might be groups such as Jana, Frontier, Watson Wyatt, I forget the acronym, but yeah, Watson Wyatt and those groups. Yeah, well, that's interesting. But Mercer actually plays a very different role in the Australian market compared to what happens globally. As a straight asset consultant, they're not so strong, but they're a very strong retail platform player in Australia. So it kind of highlights that they've actually tilted their business model quite differently. And your reaction is so typical, and it's a terrific reaction because when we show this to other managers coming into Australia, they gasp just like you do. And they're saying, oh my goodness, why aren't they huge asset consultants here? It's because our market is quite different. And it might also be our market's quite concentrated. And so the way we operate down under probably has to be a little bit different. And a nice way to illustrate that is there's been a lot of pressure on our pension funds to consolidate, to introduce scale, make it easy to transact, and introduce administration efficiencies, those kinds of things. You can have the downside is it's been a bit anti-competitive because you can't really have competition if you have not many players in the market, and if there's constant pressure from regulators and government and politicians for big funds to merge and join together and therefore squeeze out the small players, well, by its nature, it squeezes out competition. And innovation tends to come from smaller players in most markets. As a result, you throw a blanket over the biggest 20 pension funds in Australia, you have 95% of the market. You then start looking at what's really going on with our marketplace is the not-for-profit market, being the industry funds, public sector funds, they are running the table in terms of superannuation. They are 50% of the funds under management. They attract 2/3 of the contributions, the deposits into the funds. But also one of the really surprising, well, is it really surprising? But one of the big things happening in our wealth management market is disintermediation. When I first came across that word about 20 years ago, it took me about 6 months to learn how to pronounce it. But it's a really powerful force, and we're seeing it in every industry. And so many of the forces happening in financial services, it always intrigues me how financial experts will sit around a conference room table talking about the forces in their industry as if they're different. And you sort of think they're not different at all. If anything, we've been protected for decades. But the forces of technology, cranky consumers, technology revolutions, the ability of people to say, oh, hang on, I don't need to talk to gateway and intermediators anymore. I can talk straight to the source. And anyway, if I don't like your product, I can just, while I'm sitting at home watching Netflix and, watching Eurovision reruns on YouTube, I could actually be changing my investments through my app, and I can be doing this within a moment. Whereas it wasn't too long ago, these processes required a lot of administration. They required you to fill in lots and lots of forms, many that you had to fax, and it might even take several months for the accounting to go through. Now it can happen in an instant. And so part of the big push or the big trend is our financial advisor market. I've been deliberately trying to talk up the contraction in it, but to illustrate what's going on. Australia, in 2019, we had 28,000 financial advisors. Now, in Australia, we tend to talk about financial advisors, financial planners synonymously, whereas in other countries, you're much more focused on the distinction between those terms. But let's broadly call them regular financial planners. So we have 25 million people across the country serviced by 2019 was serviced by 28,000 financial planners. You roll forward a couple of years to like now, it's 16,000. So it's almost halved. Yeah, and so we're losing 4,000 financial advisors every year. Now, I used to be a high school maths teacher, so this is not complicated arithmetic, okay? If we've got 16,000 planners and we're losing 4,000 a year, if something doesn't happen, we may have no financial advice industry in Australia in 4 or 5 years' time. Now, that's a nuclear comment, and I know it's not going to get to that point, but it shows that there's been such a fundamental correction in our market. And the big aspect of what drove that was the government several years ago just said, look, we want to stop sales commissions in financial advice. So if you're going to get financial advice, it should not be driven by sales commissions paid by product providers. And that's tilted the market to a fee-for-service orientation. But at the same time, government policy has been explicitly about professionalising the industry and saying, well, you've now got to have a certain level of tertiary qualifications, and the runway for that. Well, it's probably been quite long, but it's really jolted the industry. So they've had to ramp up qualifications. They've had to change their business models. So in other words, the government has effectively come through and said, we've got to transform this industry, because after the global financial crisis and other financial events, what tends to happen is you find out who's been investing the wrong way, and then people who have lost a lot of money, they then make a lot of very valid legal complaints, which can lead to judicial inquiries in Australia, which we'll call royal commissions, but lead to major inquiries. When we do that, we find out that the way some of these financial products have been sold to consumers has just been inappropriate. It might have been technically legal, but it's on reflection it was inappropriate. It's prompted governments to change the law. And one of the big changes they've done over the last, say, decade, it's almost been a cross-government, a cross-party national project is to profoundly reform financial advice. But the cure has probably killed the patient. And so we're chasing financial advisors out of the industry. Now, this is a really big dynamic for the retail investment sector because financial advisors tend to have an affiliation with retail products. Now, I know it's not a one-to-one relationship, but they do work together. I won't say hand in glove, but they do work together. So retail products tend to be intermediated, and if there's less intermediators, well, then it stands to reason they're probably not going to be recommended as often, whereas the not-for-profit market is much more about direct distribution, which then highlights how one of the big power plays happening in the retail market is it's becoming much more directly distributed. Funnily enough, the not-for-profit sector is also trying to figure out how it can work with intermediators and advisors much more. And this is another big driver going on down under, is just like around the planet, we are getting older. Fertility across the globe is going down. So if you start looking at global population projections, Australia is not too different as is any other developed market. But so retirees, we're coming. You know, I turned 61 this year. I'm not ready to retire yet, but a couple of years, hopefully. And I intend to live a fair while after that. And 40% of all the money in the superannuation system right now is owned by people over the age of 65. You then start to think, well, it sort of makes sense that older people have most of the money because they've been saving most of their life. But that 40% ratio, as that population continues to generally age, which is happening all over the place, obviously, that ratio will probably go up over the next, say, 15, 20 years to, we would conservatively say, 60%, 65%, maybe even 70%, but it's going to be about 2/3 owned by retirees. And the big question for money managers working in Australia and the funds who appoint those money managers is, does that mean we need to invest a bit differently? And what I'm saying there is, of course, well, as people get older, they're not working anymore, so they don't have income coming in. So we want our investments to still be growing, because I plan to be retired for 30, 40 years. And funnily enough, the more educated you are, the wealthier you are, the longer you tend to live. So I'm going to be retired. And in Australia, our official, not so much a retirement age, but the age at which you can get the age pension is moving up. It's approaching 67. Don't tell people in France that. They'll start writing down under. But people are going to be retired for 30, 40 years. And in fact, one of the largest demographic groups in Australia is people who are older than 100. So our pension funds pretty soon are going to be having to deal with many thousands of members who are over 100 years of age. But if we want our money to last that long, it's got to be invested from the point of view of capital protection. But at the same time, people want investment income. So does that mean we've got to start rethinking our very pro-equity approach to Australian investments? Or do we need to rethink traditional portfolio construction, where if I want a portfolio that generates income, I don't need to just put it into bonds? Because let's have a look at what happened to the bond market the last couple of years. It's let's just say it hasn't performed at its best, and to the point where the equity market, as badly as equities got smashed, they got smashed less than bonds. So maybe we need to rethink this view of equities versus bonds in our portfolios. But that also highlights in Australia we're probably more comfortable with alternatives than some pension fund markets, and we're more comfortable with unlisted assets. And that then brings you back to some of the valuation issues that you mentioned before, Goshka, in terms of North American real estate and valuations post-COVID, working from home effects, all those kinds of things. So there's a lot of dynamics in the Australian market, but it is fragmenting, it's disrupting massively. But what is kind of interesting, despite the fragmentation, as an industry itself, it's never been healthier. 17% of all wages and salaries earned in Australia are paid into people's superannuation funds. Now, we have compulsory super in Australia, which might sound anathema to some of our North American friends. Even conservative politicians in Australia are really comfortable with what is effectively socialised retirement. But the reason I'm going on about that is compulsory contributions in Australia right now are 10.5% of your wages. But on average, across the economy, people are putting in 17%. Now, that's very concentrated amongst wealthier people, of course, but it does show how much money is going into the system. We've been through COVID. We're having real troubles with investment returns, though they are kind of spiking back. I have this saying, just from years of doing this, retirement funds just have this uncanny knack of surprising on the upside. Just when we think it's the end of the world, our fund managers and markets themselves just surprise us. Every time there's a hit, we tend to bounce back. This always happens. It's happened through history. But when things are bad, we just tend to think, oh, it's going to be bad forever. In the same way, when things are good, we think it's going to be good forever. And as we know, the human condition is not like that. And so we're quite optimistic that we could be having fairly strong returns this financial year. Last year was one of our worst returns on record. The year before, however, was our best year on record. Just shows you how volatile things are right now. But it's almost like consumers across the country have said as a collective group, look, we just got to get back into the savings game. It's really, really difficult. We had a big hit during the COVID lockdown when the economy's really quietened down. But we're now starting to save again. So Australians put more money into superannuation than ever, and we're pouring money into bank savings term deposits. It's almost like Australia just seems to have this knack of creating capital, but the big issue we struggle with is what to do with that capital and how it should be invested, which comes back full circle to why we're probably having this discussion, is when we invest money, we like investing globally, and we are really comfortable dealing with global money managers. One, because they're very experienced, they know how to do it at scale, and they clearly often have just the wherewithal that might be a little bit ahead of some of our local institutions. But also maybe some of our local institutions are a little bit too used to working in an environment where government policy almost protects them. I mean, the fact that we have compulsory savings, it's almost like the government is telling everyone you must buy these products. So therefore, the people who provide those products are sitting pretty. And does that make them a little bit lazy around the edges? Well, at times, perhaps. And so when we have big players coming in who are just really used to delivering pure investment management services, we don't really have equivalent brands that do the same kinds of things, or at least not at that scale. So I've gone on a little bit of a wildlife adventure there, but I think the Australian market is a really exciting marketplace. We love working with overseas players, but that's because we love working with smart people. We like to think that as Australians, we contribute to the planet. We like to think that we are reasonably smart. We also know we're a centre of innovation. We are world leaders in particular industries, and also it's also quite intriguing that in terms of how we manage our financial affairs. I mean, even though we might be complaining about national debt in Australia, Australia's national debt right now is only about 35% of GDP, and even though we're talking about debt being out of control, we're only talking about it getting to maybe 40% of GDP. So it's almost like we've got quite a nice way of running things. But we are having big, profound discussions about what the long term will be, because as we know, the global economy is changing. We've got to start thinking about sustainability and ESG and carbon management and those kinds of things. And as a major resource economy, that's a threat to Australia, but also a massive, massive opportunity, because if we want to electrify the world, we're going to need minerals and rare earths, and we also think we're big players there. So while the rest of the world or other countries are struggling with national debt and budget deficits, our government has just delivered a budget surplus. So Australia, I think, is actually nicely positioned. We're in a good part of the world. So much growth is happening around us in the Indo-Pacific. The economy is actually, given what's happened, surprisingly healthy. As a commodities economy, we've done really well the last 12, 18 months. We don't need to go into the dynamics of what the Russia-Ukraine war has done to global food chains and energy supply chains and all those kinds of things. But Australia has benefited from that. But it also means that it illustrates how volatile things are and how sensitive we need to be. And we also need to start working with our financial sector as almost part of our national security, national economic policy apparatus. And in Australia, superannuation and investment policy investment managers and the wealth sector is actually seen as part of our economic infrastructure, and it's taken very, very seriously.
Well, Alex, we we could talk about this for hours. This has certainly been absolutely eye-opening for me. Australia is indeed a small but also very big country. I think several things that you mentioned are so attractive to global asset managers. I think one, maybe if I were to single out one, is that persistency of inflows, which is related to the fact, as you explained to us, of that growing proportion of incomes, employment incomes that have to be contributed to the superannuation system. And that, at particularly at times when inflows in other retail asset management markets are so difficult to come by, with many investors globally on strike, and moving a lot of sucking away a lot of money into deposits and safety zones. It is really interesting and encouraging to see a market which, by virtue of its kind of institutional setup and commitment to the retirement system, is really continuing to generate such strong inflow. So with that, Alex, I'm going to say thank you, a big thank you. We must return to the topic of Australia and Eurovision in another episode. Thank you very much, Alex. And that is a wrap for us in May. We're now in the final stages of finalizing our household wealth work in Canada. That's a biennial report. Stemming out of that will be a lot of ideas about the future of asset and wealth management. So you'll hear more about that in upcoming episodes. And as always, I encourage all listeners to ping us with any ideas for specific topics or specific industry guests that you would like for us to invite. I'm working on a number of different invitees for the upcoming episodes. In the meantime, thank you very much. And on behalf of ISS Market Intelligence, I wish all of our US listeners a great Memorial Day weekend, which is coming up. And for the remainder of us, have a great rest of the week, and we'll hear you next month. Thank you very much.